Well, let's get started. I think we're not in the very beginning of the presentation here, Trevor. Yeah, there we go. So this is the let's get started with some thoughts on what we wrote recently and also some of our views. Um, the chart evolves around the dollar a lot, and today is a good day to talk about that because the dollar is certainly devaluing versus other fiat currencies, and that's our view that's we're likely going to enter a long-term period of devaluation of the dollar that could trigger a lot of ideas. We talked a lot about metals and mining, but I'll talk a little bit about AI as well here because I think it's important. But I think not a lot is talked about when we talk about deficits. A fiscal deficit is all over the news, and the fact that government spending is one of the largest we've seen in history. But what about the trade deficit? Trade deficit, which we know Trump is going after that through new trade agreements and tariffs and so forth. But this certainly looks like a structural problem when you look at the chart over a very long term. I don't think we've faced anything. And I like to look back in the 1940s or 1970s often, and I'll do this again in this presentation. But are those real comparable periods? Even the 1940s, I mean, look at this chart and you can see that the current account of the US relative to GDP was actually much more of a surplus than even a deficit at that time. Is that really comparable? And when you think about a country, it's got two ways of making money. I'm simplifying, obviously. One way is to collect taxes. And we know that we're spending more than what we're collecting in taxes. And the second way is exporting more than importing. We're losing in both ways. We call this a twin deficit. And so basically think about this as an exponential growth of the debt, given the fact that you're running a double-digit twin deficit today. So it's about 5% of GDP on the current account, plus another 7, you get about 12. And so, look at this chart. The only time we've seen something close to this type of trade deficit was in the 1800s. But in the 1800s, the U.S. was really going through sort of its emerging market moment, right? It was receiving a lot of capital from the U.K. It was a large, believe it or not, it was a large importer. How did it fix it over time from the 1800s to go from a severe deficit to a surplus? Agricultural commodities actually was a big part of that period that helped the U.S. to get out of that situation over time. Today, we're much more maturing than an emerging market, obviously. We can say, and I should also point out that, you're facing not just the current account issue, you've got the fiscal issue, and you've got the debt problem already at all-time highs. And so, it's really those three imbalances. And then on top of it all, you've got a dollar that is at one of its most overvalued levels in history. So in this letter, if we go to the next chart, I dive in a little further into something that happened during the 1970s. Again, not a perfect comparable period, but it is important to see how we design policy at that time. Nixon was facing a lot of pressure with the dollar, and he broke the gold standard because we were seeing the depletion of our gold reserves, given the convertibility at that time. And so we closed that window. We didn't allow that to happen, but that didn't fix the problem. At that time, they were worried by the fact that we were spending too much on the deficit front. By the way, the deficit was less than 1% of GDP. Today, 7% of GDP. And we were also supposedly deteriorating our trade balance, of which was 0 point something percent of GDP. And in some moments was actually flipped to positive. And so when you think about how he fixed that, well, he called it a balance of payments crisis. And he basically went on to put on tariffs of about 10% in some specific economies that were running a large surplus with the US. Those were Japan and Germany mostly, and forced them to basically revalue their currencies. In other words, strengthen their local currencies relative to the dollar substantially. And so that was basically how we saw the U.S. fixing its concerns at that time with the trade balance. And I think that that's a very maybe a framework that we should be considering in this environment. So when I look at a chart like this, it's almost like a line on the sand. This support that we've been seeing for some time now. I mean, the DXY index, which is what tracks the dollar, it's probably one of the most used ways to track the dollar. It looks at versus the British pound, the euro, the Japanese yen, and some others, and it's been hitting this support for some time now. Also, I would say I have a very different view from other people on this. I think a strong dollar, and I don't think it's factually correct, actually. If you look at the chart of the dollar and the S&P 500, it makes sense that they actually move together. Now, the dollar receives a lot of capital, so U.S. dollar-based assets receive a lot of inflows, and you see that reflexivity playing its role in the markets, and an appreciation of U.S. assets tends to occur. Now, when you see the flip side of that, when what I'm trying to make the case here, of which we might be entering a multi-year decline of the DXY index or the dollar versus other fiat currencies, not just the dollar versus hard assets. That's one side of that issue. And I do think that that's going to become a policy, not even, a kind of a market mechanism that might kind of a escape valve, as we may say. And so I think we're in the process now. Right now, we're hitting into support again. And if you ask me, I do think we're going to break it, and eventually we're going to go a lot lower. So let's go to the next chart. Because one thing that comes to mind a lot is that, it's funny to see people talk about inflation is decelerating. And I think if we had other people, looking at our financial situation today, forget about the people that are so, fixated on today's economy. But no, try to put this into perspective. If you're, from the 1900s, and you look, and somebody asks you to look at the situation in the U.S. and they say that the U.S. is running a 7% deficit to GDP today, how in the world can you even claim that inflation is decelerating? It's just, it's impossible to see that type of behavior when you're spending that type of capital and flowing money into the economy of that degree. And so when I look at a chart like this, of which is comparing the waves of inflation in the 1970s with inflation today, I do think it's I think we're going to see something even worse than we saw back then. Not in the sense of, no, in here, it gives you a sense that we're in the third phase. I don't think we're in the third phase. I think we're going to see multiple phases here because of these structural problems we have in the commodities industry and some other issues that I will talk about it. But I do think that, claiming that we're seeing a deceleration of inflation, and the whole point of this is this situation with the Fed. The Fed having to lower rates as we see deficits unchanged. It's still a 7% of GDP. And we're seeing signs of inflation coming back. What are the signs? I'll talk through it. But, you got money supply at all-time highs. You have the dollar weakening. I just talked about it. You have the deficits, as I just said. You have the big, beautiful bill that was just passed. Look into that whole bill. I mean, it's just telling you a green light for spending. And then the fourth one is, Fed lowering rates, and the commodities index is up double digits in the last year. So, I do think this is not in the data yet, potentially. And, the real inflation is obviously much higher than what's been reported if you look at the real world. And so I do think an acceleration is a very plausible thesis. Let's go to the next chart. So let's talk about a little bit about AI. AI is, I think it's going to create it's something unique. I like the comparisons with the internet. I like the comparisons with the real world in terms of productivity growth and in terms of, what this could mean for society in a lot of ways. What I don't like about those comparisons is that what is different about AI is that it does feel like a war environment where countries are trying to get there first. And nobody knows how this is going to land, right? I mean, we don't know how, if China gets, ahead of the U.S. in terms of technology, what would the world look like in that situation? and or another country, who knows, Russia or Europe. And so there is a sort of a need of an arms race when it comes to infrastructure development and making sure we have the landscape to allow AI to also take its place. On top of it, we also have onshoring. That a lot of reasons you can come up with that this is also kind of a wartime level of policy when it comes to the agenda from the Trump administration and others. Even Biden was supporting this too, and I think will be supported by any president in the near future. Is this attempt to bring back manufacturing in the U.S. and build factories and so forth. So when you put those two things together, I think it's going to create a world of spenders versus earners. The spenders are going to finance the infrastructure, and the earners are going to compound. They're going to be the ones receiving those funds and potentially, creating value in the economy. So that rotation out of one place into another place. And it is important to think about, well, how is this going to take place? Because, the government is broke. I just showed you a bunch of charts. The government can't afford this. So where's the money going to come from? Well, surprisingly, I do think there's ways to that we can see a lot of capital flowing into those areas. And I'm going to talk about 3 pillars that I think are going to be important here. We can come up with a lot more, but I do think simplifying the idea is important. There's 3 pillars of investments that I think are going to be really important in this arms race that we're about to see. Energy, and you can come up with ideas on natural gas. You can talk about solar panels. Some people like to talk about nuclear. Nuclear is a solution for the long term, not near term. And you can talk about a little bit about solar or the coal industry coming back and the revival of those aged assets. That's one portion. The second portion is the infrastructure that we need. And so you got utilities, how will the electrical grid look like? We're going to need to send energy, natural gas. So we're going to have to build pipelines, data centers, and all these things are being built already. Factories. And so the infrastructure is key. So the construction companies, engineering companies, all these guys, industrials, they're all going to likely to be receiving some of those funds from the spenders. And then the third one is, to me, the most, arguably the most critical, just because of where we are in history of that industry itself. It's always been a legacy space, materials, raw materials, and it's just gone out of favor for a lot of, I would say, investors overall. I think Quinton has said this many times, and I like that idea of looking at geoscience enrollments in universities and all. There's so many ways you can think about how materials, that whole sector of the economy, have been, basically forgotten. And so, thinking about that way, that's another place that is likely to receive a lot of capital. You can come up with not just the metals and mining space. You can expand that a bit and think about steel producers or iron ore and all sorts of things, or cement. All these things are going to be very important to build this world of spenders versus earners, in my view. If we go to the next chart now, where's the money going to come from? Let's answer that question. I do think it comes from the top Magnificent 7 companies and the others. And there's a lot of ways you can think about this. I was curious, and I wanted to see, do they have debt? How much do they have in their balance sheets? Well, they have about close to $3 trillion in their balance sheet on assets, okay? And then how much debt they have? Well, in aggregate, they actually don't have any debt. Believe it or not, they are actually having a net cash positive amount of about $70 billion that they can spend. So when you hear all these ideas that they've been announcing, hundreds of billions of dollars of spending, if you just consider the fact that they may lever up their balance sheet, like any company would probably do in that position, take some debt. Well, they have room for that. You can have room for trillions of dollars if you want to. Over the next 10 years, it would not surprise me at all if we go from net cash to maybe 40-50% of debt to assets ratio. How many companies run their businesses with that level of debt? It's actually quite normal. And so I do think that that's where the money will be coming from, is leveraging the balance sheets of these large companies. So do not, I would say this very carefully, do not, estimate what could come from in terms of capital raise of that part of the economy. The other thing we gotta understand is, well, how will valuations work with that? You're going to see a major deterioration of the health of the financial of these companies, right? Obviously the balance sheet is going to probably, if assuming I'm right, let's just make an assumption here, um, um, and you go from net cash to major amounts of debt in 5 to 10 years from now. Where will valuations rest? Will they stay at 50 times free cash flow? I happen to think we're going to see a compression of multiples at some point, because I think that's unsustainable. That's where the money has to come from as well. And you can say, well, can they raise equity? Well, where's the money going to come from? The money is already there. It's like, 75% of the world index is in the US. So you're telling me that 25% is also going to come to the US. Well, I don't think that's really where the meat of these capital raise is going to come from. I do think it's going to come from leveraging up their balance sheets. So that's my 2 cents on that. Now you can go to the next chart. There's another possibility of where the money could come from. Their free cash flow. So if you think about their free cash flow, generating about $450 billion, right? So $500 billion every year these guys are producing now in free cash flow. Okay, well, we haven't seen the spending yet, like they've been claiming that we're going to be spending. 80% of that free cash flow is going back to shareholders today through buybacks or through dividends. Okay, well, there's room there. We can reduce that by zero, or maybe that's an easy way to raise $400 billion every year that can be spent on the earners. So again, don't underestimate the possibilities that we have here to make changes in terms of where capital could flow. And so I do think this is going to be a huge rotation in this market. Anyway, let's go to the next chart. Now let's talk a little bit about inflation, because I dived in a little, talked to, think about the spending, think about the construction, all those needs. And look at this chart, for instance, something I've been looking at a lot, a lot of these surveys that come out for manufacturing, and they ask questions about prices being paid. And what is remarkable about the inflation data is that a lot of this reacceleration of prices that we're seeing is actually going into the service side. And so it's nothing to do with tariffs, actually. You can add the tariffs and say that tariffs are also intensifying those trends, but it's actually coming from services. I guess it happens to be the case that when you're spending 7% of GDP every year on fiscal expenditure, it does flow into the economy. And so I do think that that's the case. If we go to the next chart, you can see here, as I said before, commodities up double digits. I mean, that's the equal weighted index of commodities. So, some people will say, well, what about energy? Well, you need to look at the whole thing. And so agricultural commodities, metals have been going up a lot. And so, some agricultural prices or commodities have also experienced a surge in prices too. And so, I happen to think that energy is I believe in the rotation dynamic of commodities. I think agricultural commodities and metals have been kind of leading the pack here. At some point, it turns into energy. And so, I think that's important as well to think about. Let's go to the next chart. And then lastly is the situation of commodities versus inflation expectations. You have this alligator mouth again. Inflation expectations today are rising after this situation with the Fed. And I have my views in near term here on all this stuff that is happening. I happen to believe the Fed is not going to cut rates in the very short term. Of course, I think in long term, it's hard to believe they're not going to, because they have to. It's almost like we're fighting this fiscal dominance. Like we have to lower rates to lower fiscal spending. It's crazy. And so, and forget about inflation, because inflation needs to run hotter than historical standards so we can deleverage the economy. And so I think that that's, a catch up on this divergence that you're looking at the chart there, where inflation expectation could be going along with where commodities are now. But anyways, let's go to the next chart. And money supply is the last thing on the inflation front that you can see here. Money supply at record levels. You can look at the year-over-year change of that too, and it's about 8% growth. So many ways you can analyze this data in terms of the reacceleration of the indicators that tend to lead to inflation at some point. And so, we're certainly still in an inflationary era. We're probably going to be here for maybe a decade or so. And the spending necessary for AI and all sorts of things is just going to feed into this whole idea as well. Let's go to the next chart. So now the idea, there's, ways to capitalize on these things. I said that I happen to really like that materials section because I think it's really undervalued. And I find it fascinating that we're starting to see some of that, those flows of capital coming into the space of gold miners. I thought that the beginning of this was going to be led to fundamentals improving. And now, fundamentals are improving. But I do think that a lot of the move in the miners in overall actually came from necessity. It came from, people starting to think, well, where are materials going to come from? It got to come from somewhere. I know, and they might not be the most profitable businesses right now, but maybe it still deserves or justifies an allocation. Well, guess what? Now they're also looking very attractive and compelling in terms of the fundamentals. They are improving substantially, especially in the last few years. Most of the miners are probably producing, gold specifically at half of gold prices are today. All-in sustaining costs in the median basis is probably, still below 1,500s or so, while gold prices are 3,300 or so. So it's pretty interesting that, fat margin that some of these companies are experiencing now. Anyways, let's go to the next chart. Now, let's talk about one thing that I learned from Pierre Lassonde, actually. I was listening to a good interview with him in Gold Telegraph, and he talked about one aspect of why, maybe we haven't seen the mining industry behave so well over the last decades or so. And he thought this was also, maybe more of a long-term issue being caused by the pension funds in Canada. So I did more research on this because I was curious as well. And, basically about 40% of the precious metals industry today is, in the Canadian exchange. So it is a quite significant amount of their of the market. And so, lots of companies go there for many reasons. There's a standardized way of issuing your company in those places with 43-101s and all sorts of things that other countries don't provide yet. And so a lot of companies go there in order to access capital. And back in the days used to be the case. I think Quentin would maybe even be able to comment on that. But back in the days, the whole reason was because there was more liquidity. And that case has been shut down because there is no liquidity. And maybe the reason for it has to do with what's been happening with the pension funds money in Canada. Just to give you some sense, only about 4% of their assets is invested in domestic public equities now. And so, I thought that was an interesting number. And so, well, look back in other G10 economies, because why G10? Because most of the developed world countries have some sort of pension, more kind of a defined, formula for that. And so you have here, the U.S. is about 42%, not a shocker. Hence why we have so much capital in the U.S. And most of these other economies, if you just do the math, potentially the other side of their balance sheet is probably in the U.S. So Japan, 24% is in public equities in Japan. Where's the other 75%? Maybe half of it is in the U.S. It wouldn't shock me at all, even if it's more than that. Now you can run those numbers even further into these other economies too. Now, if you go to the next chart, all right, well, that 4%, what has been in history, and that was his point in his interview, was that used to be 30+%, almost 40% at some point, and now it's down to 4%. I'm only going back to the 90s here, and you can see that back in those days, the Canadian pension funds were a big, part of the market at that time. Just to give you some sense, Canada has about $2.3 trillion of GDP. The pension funds in Canada are worth they have in assets about $2 trillion. And so, it's a substantial amount. That would make an impact if we start seeing those flows going back from 4% maybe to 10%. to me, this is all optionality when it comes to investing in this industry. And I would say that, Russell Napier is a professor that I really listen to him. I think that's one of the best voices in the macro community. And what I like about him is that he talks a lot about this onshoring of economies, but not just the US, but potentially seeing this across multiple economies. And so, Japan seeing onshoring, Canada seeing onshoring, Europe seeing onshoring. And so think about all those pension funds that I said and the assets that they're investing in public domestic markets coming back, and what would that do to those markets? I do think that that's where you see that rotation out of the US into those other places in a large way. So, that staying balanced. I think we're going to see this moving upward in the future. That's my opinion. Let's go to the next chart. All right, I'll go quick, putting my skates on now, as some like to say. Gold miners to gold ratio. Today, we're seeing a breakout of this trend. And this chart is good because I think it gives you some sense. I mean, have we seen, some miners are making all-time highs, some others are getting close to it, and it makes you think, I mean, have we seen most of this trend? I don't think so. I really think that in order to see that play out, we're going to see the money really flowing into and taking more risk. I mean, the normal bull market, what you tend to see is that investors gradually go up on the risk curve. They get more confident, they take more risk. And so we're not seeing that yet. We're seeing the beginnings of that. And that's one chart that you can see it. If you go to the next chart, you can see what's been happening more recently as well, where gold has been going basically sideways since April. I think it's more of a consolidation, nothing to worry about. But what is remarkable is that the blue line is the TSX Venture. Those that I guess follow the industry well know what that is, but that's, looking at the subgroup of precious metals. So that's, if you don't know, those are the very small cap companies in this industry. Most of them are exploration companies. That's usually, the higher risk that you can go in a spectrum of the overall industry. And so you're seeing a 30% move in those stocks as well. And so, at a time when gold has been going sideways. So certainly that's another way to see that investors are rotating from gold prices into those other areas that they're taking more risk and feeling more and more comfortable. And I do think that those are very clear signs that we're probably at the beginning of a bull market in the overall industry as well. Let's go to the next chart. I'm very close to being done. The last one is just putting into perspective of gold prices too, because I looked at the miners to gold ratio and I said, well, it gives you some sense about how, potentially early we are in this whole thing, and in a bull phase of the mining cycle. And where are we with the gold prices as well? Well, you can look at the gold versus the U.S. equities ratio, and gold is still very close to that undervalued or cheap, historically speaking, level. And so I suspect that we're also at initial phases of something that will take a very long term to unfold as well. And so to me, this is one of the most attractive industries to be deploying capital into. Obviously, our views, obviously.